Okay, good morning. Welcome to Forex Winners Club. You will be seeing this FWC frequently. FWC is the code name for Forex Winners Club. Right away, I would like us to start by having you take note of where you can find us online. Forex Winners Club can be found on Telegram. If you are able to search on Telegram, you should be able to find us on Forex Winners Club also. That is one of our groups, Forex Winners Club, the one I'm showing you on the chat, on the screen. And you can also find us on, so I expect you to search for Forex Winners Club and join. Please do that later. Then we have Forex Winners Club also available on Facebook. We now have a growing team here on Facebook also. You look for Forex Winners Club. Okay, so we can see we are here. We are now having almost 7,000 members on Facebook with more joining. You can also find us on YouTube, Forex Winners Club as well. So if you are on YouTube, look for this name, Forex Winners Club, and subscribe and start watching our videos. Now, I will say that this is a very important course for you and indeed for anyone who takes that. This is the course outline, or what you might call the course content of what we intend to cover. Now, I've not covered the basics of Forex. The basics of Forex are covered here. I did these lessons and I uploaded them to YouTube so that people can watch them at their own time. So before you start the course, or as you continue, make sure you go and watch these videos so that you cover the concepts, the core concepts, definitions of terms. What is Forex? Advantages of Forex. Market analysis, that is technical, fundamental, and sentiment analysis. Brokers, how to choose a broker. Charting software, types of orders and how to place them. So there are those definitions and basic concepts that come in before you start trading that you need to cover. And I thought if we started covering these things at the beginning of the course would take longer than 10 days or longer than 2 weeks as we have planned. So again, head over to Forex Winners Club on YouTube, subscribe, and start watching the videos. The first one first. So watch them in sequence. From here, this becomes your first video, second video, third video, fourth, fifth, sixth, seventh, eighth, and ninth. So watch them sequentially or chronologically based on how they were uploaded. So I believe that should be fine. Assuming you will be able, or you have already covered the basics of Forex, definition of terms and things like that. Now, in our course outline, this is how we intend to progress. We will, at first, start by looking at technical analysis. We will introduce ourselves to technical analysis. This is one way of analyzing the Forex markets or Forex charts to try and identify trading opportunities. There are other techniques, like I showed you on YouTube. You can see there's technical here, there's fundamental, and there's sentiment. We mostly use technical analysis as price action traders. This is a price action course. And being a price action course, we depend on technical analysis most often. After we have done technical analysis, then we will move to Dow's theory. Now, Dow's theory, this is a theory proposed by one of the early traders and the researchers in Forex. I think the name is Charles Dow. He's the one who is credited for creating a price action way of determining the trend. So Dow's theory will help us understand market structure. Dow's theory will help us understand market structure. What is an uptrend? What is a downtrend? What is a ranging market? Then apart from using Dow's theory to understand uptrends and downtrends and ranging markets, We will also use moving averages to try to figure out the direction of the market at any point in time when you are on your charts. So that will be topic number 2. Topic number 3, we will cover candlestick patterns. Candlestick patterns. These are very important components in price action trading. Now, with candlestick patterns, we talk about things like engulfing patterns, pin bars, inside bars, and sure, many. I need to remind you this video is being recorded. I'll be able to share it with you after the session. So kindly spend more time understanding what's happening, because you'll get a recorded version of the same, so you don't have to write much. So after candlestick patterns, then we'll talk about support and resistance. Support and resistance, I combine it with trend lines, although trend lines are also a form of support and resistance. Now, this is a very important aspect in trading. You need levels, and support and resistance together with the trend lines will give you market levels from where you can place a trade or exit a trade or manage a trade. So that will be very important. Then we talk about supply and demand zones. From the beginning, you need to be aware that in the market, in any market, whether Forex or binary options or stocks or commodities, what makes the market move up or move down are the forces of supply and the demand. Supply and the demand determines where markets will change direction from, where markets will head. You know, what happens in the market simply something that's contributed largely by the presence of supply and demand forces. Supply being facilitated by sellers, people are willing to sell something, and the demand facilitated by people who are willing to buy. So when the demand is high, that means when we have a lot of buyers in the market, what happens? Prices will increase. When we have so many people wanting the same thing, prices will increase. But when we have a lot of people trying to sell the same thing, okay, then the prices will fall a number of times. So more sellers, fewer buyers, prices will go down or fall. More buyers, fewer sellers, prices will go up. So that is all about supply and demand. We'll be able to talk about it later. Then we talk about pivot points and Fibonacci retracements versus extensions. These are also additional components in price action that will tell us market structure. Actually, the levels where we can buy, the levels where we can sell, and where we need to manage our trades. Then topic 7 will be breakouts versus pullbacks. There are people who trade breakouts, there are people who trade pullbacks. We want to learn all of them and possibly recommend which option is better to trade. Then we'll also cover reversals and trend continuations. For sure, there are people who like trading reversals. When they see a market moving up, they want to sell so that their prediction is the market will start falling, or the market is currently falling and they want to predict the market will start moving up. So they are simply trying to trade the reversal of a current trend, as opposed to another group of traders who want to continue the trend. So they are called trade continuation traders. So we look at both cases and possibly figure out which is better. Chapter number 9 is not part of price action directly, but we will cover it indeed, because there are people who trade this technique alone. So we look at effective chart patterns such as double tops, double bottoms, triple tops, triple bottoms, rectangles, triangles, and head and shoulder patterns. Many other patterns. We'll be able to look about at least nine chart patterns on the chart that you can see and analyze possibly. I will also be looking at 9 candlestick patterns that I considered high probability candlestick patterns that can be used in trading. Then later on, we talk about divergence trading. Divergence trading, I understand, is a very important concept, and I'll be able to show you how you can benefit from divergence when a market is going one direction and an indicator is going the opposite direction. What do you do? Then we will look at Bollinger Band squeeze and spike for breakout trading. So if you want to be a breakout trader, you can benefit from Bollinger Bands, which inform a trader of volatility in the markets. When they squeeze, it's low volatility. When they expand, it's high volatility. When they squeeze and then followed by a spike, it means a breakout is happening, most likely. How do you jump in and benefit from the trade? Then chapter 12, this is supposed to be a complete course on its own. Mark that. Volume price analysis or volume spread analysis, VSA. VSA is a complete course, and I'll be offering it as a separate course. But in this price action course, I will mention a few things about volume that would help you, become a better trader in the Forex market. Just a few things that can help you analyze the market better so that you have better signals and most likely better results from your trading experience. Chapter 14 will be confluence trading. Confluence trading here, we'll be talking about before you enter a trade to buy or a trade to sell, you do need several things to tell you the same thing. So that if you think of buying a currency, several things should tell you, yes, buy. Several things will tell you the same thing. For example, you have a support and resistance, you have a moving average, you have a trend line, you have volume. All of these things could be saying it is the right time for you to buy a given currency pair or to sell it. Then I will share with you 5 power price action strategies that I personally use also. These are strategies you could, once you master them, you start using them when trading. This is the actual trading now, chapter 14. Then the last one will be money management and the trading psychology. Everything from chapter 1 to chapter 14 is important, yes, but that's half the game. That's half the game, because money management is also a source of trouble for many traders. Psychology is also a source of trouble for many traders. So money management, for example, we will teach you that you cannot open a trade with more than 3% of your account balance. You cannot open a trade. You cannot use more than 3%, or you should not use more than 3% of your capital on a single trade. That's part of money management. Part of trading psychology is people should be patient. We teach patience. If you open your chart and can't see a trade, go away. If you open a chart and see a trade that's coming in the next 5 minutes, wait for the 5 minutes. So we teach patience. We teach focus, that you need to concentrate when trading. We teach discipline. We teach discipline. You need to have a plan on how to trade each day. If you want to take 5 trades each day, stick to 5 trades. Okay, that's part of discipline. So we'll cover those things in chapter 15. So that largely, this is our course content, and it's what we intend to cover. So over to you. Now let me know from your comments. Let me see from your comments. Are you okay with the structure we have in advance on what we intend to talk about? Please type a message there if you are okay with that. That's the course outline. We are yet to start chapter 1, then chapter 2. I will combine chapter 1 and chapter 2 today because they are easier topics to cover. So type for me a message, okay, if you think we are together. Very good. So we will head over to chapter 1 and chapter 2 combined. That's what we'll cover. But let me know, have you learned anything about Forex yet at the moment? So far, have you learned something? Have you been reading something on Forex? Have you been reading anything on Forex? Please use the chat box to just reply. If you have been reading things like what's the definition of Forex, things like pips, you've read about, Forex or types of orders, you've read things like leverage. Oh, okay, you probably have covered some of those things, but not in detail. Now, like I recommended from the beginning, head over to Forex Winners Club on YouTube. I can send you a link. Let me send you a link right now so that you can sign up. Start watching those videos from number 1 to the end. They will help you a lot with the basics. So stay subscribed on YouTube. That's our channel. Let me also give you the link to our Forex group. The link to our Forex group is here. Okay. That is Forex Winners Club. You can search for that and be able to find it. Or I can add you to the group, whichever is easier. Let me see that I can add you to the group. I think I've added you to the group for Forex Winners Club. So we will proceed from there, considering that now, please go to, when you are ready for the basics, go to our YouTube channel and watch the basics there, the videos. So straight away to chapter number 1. Chapter number 1 is Introduction to Technical Analysis, and we'll also cover trend analysis. Now, technical analysis. For a trader, the business of a technical analyst is simple. When you get to the chart, when you get to a Forex chart, your business is to look at the chart and be able to make a decision. And the decision you're making is whether you want to buy or you want to sell. So our business as Forex traders is to buy to make money or sell still to make money. That's all we do. So if you look at this chart, what we are having here is a 1 hour chart, a 1 hour chart for a currency pair called Euro USD. Now, Euro USD, let me just introduce some of these things. So when you say Euro USD, that's our currency pair. Euro USD is the pair I'm having on my chart at the moment. Now, this is a base currency. The first one is the base currency. The second one, USD, is called the quote currency. Okay. So currency number 1. So if you look at the left of my chart here, there's Euro USD. You can see that. There's GBP USD. There's AUD USD. There's USD CAD, USD CHF, USD JPY, NZD USD. Those are the currency pairs considered major in the market. They are the major currency pairs. The first one is Euro USD. That is, we have a Euro currency combined with or traded together with the United States dollar. Remember, the Euro is a currency used in the European zone. USD is a currency used in the United States of America, USD, United States dollars. Then we have GBP USD. This is a combination of the pound, the British pound, together with the US dollars. Then we have AUD USD, where AUD is Australian dollar. That is Australian dollar. That's AU, Australia. Australian dollar versus United States dollars. Then we have USD CAD, where we have United States dollars against Canadian dollar. CAD is Canadian dollar, currency used in Canada. Then we have USD CHF versus USD CHF, that is United States dollars versus Swiss franc. This is the currency used in Switzerland, I think, Swiss franc. Then we have USD JPY, that's the American dollar versus Japanese yen or Japan yen, JPY, the Japan yen or Japanese yen. Then we have NZD USD, where NZD is New Zealand. NZD is New Zealand. It's a currency used in New Zealand against the American dollar. Okay, so if you open your chart, you'll see a lot of those others. There are many others. Those are the main ones or the major ones we trade. So at any point in time, as a trader, your business is to identify where the market is going to next and you benefit from it. So if you are on the market here there are only three things you can do. Number one, as a trader, you can buy. As a trader, you can buy. So when you buy, you are expecting that the market will go up. That's your prediction. You're predicting the markets will go up. That's when you buy. In Forex, buying, people also call it going long. So go long. Buy is the same as go long. So assuming the market is currently here on this line, when you buy, your prediction is the market will go up. The second thing you can do when you are on the chart or on the market, in the market, that is, you can also sell. Sell is also what people say, go short. Or you short the market, you go short. And when you are going short, you are predicting that the market will fall. You are predicting that the market will fall down from where it is. So if the current market is here and you are selling, it means your prediction is the market will fall, and that's how you will make your money. Number three, very important, is do nothing. Do nothing. Sometimes you would find a market, you will try to analyze and can't see whether you can buy or you can sell. You can't understand the difference. A market that looks quite hard to interpret. In a market like that, don't do anything, just leave the market alone. One of our policies is it's better to miss a trade than to lose a trade. It is better to miss a trade than to lose a trade. That's where we say you are better off doing nothing if you don't understand what the market is currently doing. So that is the work of a technical analyst. When you are on the chart, you are looking at places where you can buy. Like now, the market is here. This is the current candle. From here, you can analyze whether the market will go down. If you think the market will go down, you will sell. If you think the market will go up, you will buy. That's the work of a technical analyst anyway. Now, principle number one, or one of the things that you need to understand. So these are the things that we'll get to cover. For every trade you take, at least ensure, number one, you follow the trend. Always try to follow the trend. For every trade you take, ensure you are following the trend. Number two, ensure you are taking your trade at market levels. You only trade at a level. A level. These levels later on we'll call them support and resistance. Support and resistance. And then for whatever the case may be, always have something that gives you a signal. Yes, you have a trend. Yes, you have support and resistance. There must be a signal from the market that you can now buy or you can sell. And these things I will teach you in this course. How to identify trend, how to identify a level, and how to pick a signal for you to either buy or sell. Now remember this, when you buy, let's say this is a place in the market, when you buy and the market goes up, you make money. If you buy from here, but the market goes down, you lose money. Please get that right. If you buy, market is currently here at this level. If you decide to buy at this level, you only make money if market goes up. If you buy and market goes down, you lose money. Now, let me do it differently. If you are selling at this level, market is currently at this level, you only make money if market goes down. This is how you make money as a seller, if market goes down. But if you are selling, if you enter sell trade and the market goes up, you lose money. You lose money. So it's about predictions. You have to predict the correct way. You have to make good predictions. You have to make good predictions. Okay? You have to make good predictions so that you can at least make money from the Forex markets. So we are done with introducing ourselves to technical analysis. So as a technical analyst, you will need to cover, analyze trend. So these are the things a technical analyst does always. A technical analyst is one who can understand the current trend on the market. Trend. A technical analyst is one who analyzes market trends. A technical analyst must be familiar with candlestick patterns, bullish engulfing, marubozu, etc. A technical analyst is one who can properly draw support and resistance and the trend lines and use them. A technical analyst needs to be familiar with supply and demand zones and be able to use them to enter a trade or manage a trade. A technical analyst should also be comfortable with pivot points and Fibonacci extensions and retracements. As a technical analyst, you need to know the difference between pullbacks and breakouts, reversals and trend continuation, and effective chart patterns. You need to be able to spot them on the charts on your MetaTrader 4 or whichever platform you're using. You should be able to identify effective chart patterns and use them. You also need to be familiar with divergence and how to use divergence to enter trade or manage a trade. You need to be familiar with an indicator called Bollinger Bands. This is a very important indicator. It's a price action indicator itself based on moving averages. You need to be familiar, perhaps also with volume, the use of volume in the Forex market. Confluence trading, this is what gives you an edge in the market. To become a profitable trader, you need to trade confluences. And there's a topic dedicated to that. And then a technical analyst also must be emotionally balanced. You don't want to be trading when you are emotionally imbalanced. So let's head over to an important topic here called trend analysis. I want us to spend time today talking about trend analysis. This one. Now, trend analysis, this is where the whole trading begins. You've probably heard of this concept if you are studying anything online. You've heard of a concept called, the concept is called follow the trend. I believe you've heard of something called follow the trend. And if you've heard of anything called follow the trend, okay, people teach this, follow the trend. Follow the trend. Now, this is very important. And I want you to understand why the trend is important. Assuming you wanted to swim, the river is flowing from north to south. Which is the better direction to swim? Is it north to south where the river is flowing, or south to north against the flowing river? Your answer would be as good as mine. It's always best to swim in the direction of the flow of the river. It's always best that way because you will be using less energy and you will not be carried away by the river. Anyway, the forces of the water, the moving water, can carry you away the opposite route. So if there's also wind blowing from one side, if you try to run towards the direction the wind is coming from, you will not be able to move very fast. In fact, you can be swept by the wind. But if you are running in the direction of the moving wind, then it becomes easier for you to run. So when you hear people say, follow the trend, people are saying, don't fight. When you are on the when you are in the market, don't fight with those who are in the market. In the market, you only find two categories of people. You'll find people called bulls. Bulls. These are buyers. Buyers. These are the people responsible for buying in the market. They buy. For example, if you look at down here on the chart, from here to here, these were buyers, the green candles. 1, 2, 3, those were buyers. Another buyer, another buyer. All these are people who are buying in the market. So, category number 2 of people you would find is what we call sellers. sellers. Sellers are also called bears. Bears, the animal, bear. They are bears. Now, bears are responsible for moving the market down. Bears are responsible for moving the market down. They are the ones. Let me show you the bulls and bears on the chart right away so that we talk about the same thing. If the market is moving up, these are buyers. The work of buyers is to buy. When they buy, the market moves up. The work of sellers or bears moves the market down. So this is bears, or sellers. Then buyers, sellers, buyer, seller, buyer, seller, buyer, seller, buyer, seller, buyer, all of that. Now, it's important for you to be aware of a fight between the two. A fight between the bulls and bears. That means when buyers and sellers are struggling to determine where the price will move to next, you stay away from the market. But when you see the buyers are winning, you can join the buyers. If you see the sellers are winning, you can join the sellers. Do not join the fight. Just let them fight. And when you see who is winning, you join the one who is winning. All right. So that's what we call the forces in the market: seller force, buyer force. Now, when you talk about trends, the market can only move in 3 directions. There are 2 directions, but we look at them separately. Now, let me use a drawing here. If you see a market that goes up, like I'm drawing, if you see a market that goes up like this and comes down a little bit, then rises up again and comes down slightly, then goes up again and comes down again, goes further up and comes down again. Now, if you look at what I've just drawn, here, the market makes a high, moves from a lower price to a higher price, then comes lower again and goes higher. So you look at this high, it is higher than the previous high. If you look at the next high, it's also higher than the previous one. If you look at the other high, it is higher than the previous one. Let me draw the other line so that you can see the difference. The market started from low here. The next low is higher than the previous low. The next low is higher than the previous low. The next low is higher than the previous low. And this low is higher than the previous low. This, in effect, is what we call an uptrend. This is an uptrend. An uptrend. An uptrend is a market that is making higher highs and higher lows. An uptrend is a market that is making higher highs and higher lows. So this is a high, followed by a higher high, followed by a higher high. Please. Don't spend time writing. I would rather you watch, you follow. Later on, because you love the video, you can watch the video once again and write your notes, so that you don't end up splitting your focus and attention. I strongly encourage you just follow the course as it goes on. When you have the video, then you can make your notes from there, because you might be distracted trying to write and listening at the same time. Thank you. So we are saying if you see a market going high, coming down, going higher than the previous high, coming down, going further high than the previous high. So all of those other highs are called higher highs. So if this is the first high, this is a higher high. Why? It is higher than this. This is a higher high. Why? It is also higher than the previous level. This level is higher than the previous level. So that is the higher high. When the market is moving up, it makes a low, but later on, the next low is also higher than the previous low. So if this is a low, then this is a higher low, a higher low, a higher low, a higher low. Now, let's look at the chart so that you understand what we are talking about here, okay? Let's assume the market started here. That is a low. That is the low. Price went down here, then it reversed back up. This is a high. This place is higher than here. So if this is a low, that is a high. Okay? After market going up here, it went down and it created another low. Okay, but this low, if you look at the price, this low, this level is higher than the previous level. So this is what we call a higher low. A higher low. It's a low, yes, but higher than the previous low. We have a high here, then we have another high again. So if this is a high, this is a higher high. Market went up. Then after going up, market went down. It created another low. But if you look at this low, if you connect it back to the chart, this low is also higher than the previous one. So it is still a higher low, HL. Okay? Then after here, the market went all the way up to somewhere here. Now, if you look at that high, is higher than the previous high, so it is still a higher high. After that, now the market comes. So if you are able to see this, you can see that the market was going up, coming down, was going up, coming down, was going up, coming down. That's how the market moves. So a movement like this is called an uptrend, where the market is making higher highs. Where are the highs? The top ones. These are the highs. If the highs are increasingly going up, then that's an uptrend. Especially when the highs are going up, the lows are going up as well. So what you see on the chart is pretty much what I've explained. So let me give you an illustration from a live chart, like here. Okay, let's use this. Let's use this. I guess you can see that this is what the market has been doing. Assuming we start from here. Market went to that point. It moved up by the power of buyers. The market moved down. That's the work of sellers. Market went up. Market went down. Market went up, came back down, or here. Market went up, here. Market came down. Market went up, came down. Went up, came down, went up, came down, went up, down, and now it's up. Now, if you look at the way the market has been moving, then you will identify where it was changing direction, the turning points. Turning points are very important. We call them the swings. The turning points are also called swings. Okay? Swings. Now, that was a turning point at the top here. Another turning point here. Another turning point, turning point, turning point, turning point, turning point, turning point. We don't know in the future. Down here, we also had some other turning points. We had a turning point here, a turning point here, a turning point. Those are levels where the market changed direction. Okay? All of those. So this can be called a swing high, swing high, swing high, swing high, swing high, swing high, swing high. The low ones are called swing lows because the market was moving down. Swing low, swing low, swing low, swing low, swing low, swing low, swing low. Low, 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 low. That's the word. Swing lows. Now, when you see the market doing this, then you start asking yourself, is it going up or is it going down? So if we start from here, that was a low. That is the first high is here. This is a high price compared to the previous. Market was moving up, so it's a high. It comes down, that is a low. Goes up, that's a high. Comes down, that's a low. high, low, high, low, high, low, high, low, high, low. So you can always put those things there to help you. But now you start analyzing. All of these are highs, the ones at the top. All of those below are lows. Question, are they at the same level? No, they're not at the same level. This high is higher than the previous high. So it's called a higher high. This price here is at the same level as the previous one. You can connect them with a line like this. So if they are at the same level, you can call it the same high, SH, same high. This high, this point here, is higher than the previous one. So it's another higher high. This high is also higher than this, is a higher high. This one is at the same level as this, so it's called same high, higher high. Now, starting from the bottom, we have a low here. This low is higher than this, so it's called a higher low. This is the same as this, so it's same low. This one is higher than this, so a higher low. As you can see, higher low. As you can see, higher low. But now this low is lower than this, so it's called a lower low. Lower low. This low price is lower than the previous low price, so it's a lower low. But this price is above this, so it's called a higher low. This is another lower low because this point is lower than this point. So in short, if you want to understand an uptrend, you will look at a market that is making higher highs and higher lows. That's the definition of an uptrend according to Charles Dow. Dow's theory. A market that is making highs, lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Please confirm you're okay with that, even by nodding your head because I can see you. Are you understanding uptrends? Very good. So let me show you the opposite of an uptrend is a downtrend. Now we want to look at a downtrend. A downtrend is the opposite of an uptrend. Now in a downtrend, a market is making lower highs and lower lows. Lower highs and lower lows. How so? If you see a market falling like this, rising, falling, rising, falling, rising, falling. If you see a market starting from somewhere here, comes down, goes up again, then falls again, goes up a bit and falls again, goes up and falls again. Now, if you start interpreting this market, this is a high price, this is a low. Now, this is high, this is low. This is high, low, high, low. But now interpret all of this together in context. If this is a high, what about this high? This high is lower than this high, so it's called a lower high. This high is also lower than this, it's called a lower high. This point is also lower than this, so it's a lower high. Now let's look at the lows. If this is a low, this low is lower than this, so it's called a lower low. This low is lower than this, a lower low. This low is lower than this, a lower low. That's how a downtrend moves. Now, let's demonstrate this with a chart, a live chart. We get a nice downtrend that can help us understand some of these things better. So let's look at the chart from left to right, from here, okay? This market was moving like this. Starting here, the market fell, went up, all right? This market fell once again, went up, fell, went up, fell, went up, fell, went up, fell. Now, if you look at what the market was doing, then you realize that is a high. This is a low. So low, high. But the next high, this high, because we only find the high when the market moves up and moves down. These are the highs. If a market does this, this is a high. If a market does this, this is a low. So this market created a high, a low, another high, but this high compared to the previous high, this is a lower high. Then the market went down, created a low. So the lows are identified by V's. The highs are identified by inverted V's, like this. That's how you identify the highs. Those are the highs, these are the lows. So the market created a lower high because this high is lower than this. What about this high? This high is also lower than this, so it's a lower high. What about this low and this low? This low, compared to the previous low, this low is lower than this low, so it's a lower low. This low is also lower than this, it's a lower low. Now this is a high. But this high is higher than this, so it can't be a lower high. It's instead a higher high. What about this high? This high is the same as this, so we call it the same high. What about this low? This low is higher than this, so it's called a higher low. What about this one? It's still a low, but now lower than the previous one is a lower low. What about this high? This high is lower than the previous high, so it's called a lower high and a lower low. So in essence, if you see a market that makes a high, then falls and makes a low, then rises and makes another high, but the high is lower than the previous high, that high is called a lower high. A lower high. It's a high but lower than the previous one. Then it falls down again, making another low. Okay, so this low, when compared to the previous low, is a lower low. This high, when compared to previous high, is a lower high, a lower low, a lower high, a lower low, a lower high. This is a typical downtrend. That's how a downtrend moves. Now, what about another type of market called a ranging market? Ranging market. So we have seen an uptrend, we have seen a downtrend. Now let's see what is called a range. A range. Now a range is a market that looks like this. Starts from here, a low, makes a high, comes back and makes a low, makes a high, makes a low, makes a high, makes a low. In effect, if this is a low, this is a high, the next one is same low, the next one is same high, okay? Same low, same high, same low. In short, a ranging market is where the lows are equal and the highs are equal. Market starts here, stops here, comes down, stops here, goes up, stops at the same level, stops here, stops here, stops here. This is a ranging market. A ranging market. Now, let's see whether we can spot one in the market. This is an example of a ranging market. What is happening here is an example of a ranging market. If you look at what the market is doing is here, is the market stopped here, stopped here, stopped here, but these are same lines. These are same point. This high is the same as this high, and this high is the same as this high. If you look below, the market stopped here, stopped here, stopped here, and now stopped here. So if you look at all those arrows, they represent lows. The market could not go below here, could not go below here, could not go below here. Those are the same lows. So this is an example. This is what we are actually calling a ranging market. That's a ranging market. Ranging market. Now, as a beginner, if you are a beginner trader, you will find what I'm explaining slightly challenging. I want to make your life easier. Now, you can also define the trend of a market because you need to know where the market is moving so that you can follow it. That's what you do as a trader. You know the direction of the market, you will follow the market. You cannot try to go against the market unless you know also what you are doing. So you can add 2 indicators, actually 1. Now, if you go here to insert indicators, moving averages. I'm explaining a very important concept. Pay attention. So if you go to insert indicators, moving averages, or you find them under trend. So insert indicators, trend, moving averages. Click that. Make this one 50 and maybe a green color. Exponential. Make sure it's exponential. There's simple, there's exponential, there's smoother, there's linear. So I make it that. Now look at what that line is doing. Whenever the candlesticks are above my line, that's an uptrend. I'm trying to simplify life. So whenever candlesticks or the market is above the moving average, this line, that is considered an uptrend. Whenever candles are below the moving average, this is a downtrend. Uptrend, downtrend, uptrend. All of this is an uptrend. Uptrend, uptrend from here. Small downtrend, uptrend, downtrend, ranging market. If you see at any one point in time, the moving average is between candles. Like this line is here, some candles are below it, some candles are above it. That's a ranging market. That's an example of a ranging market. Here is a ranging market. Are you following? Here is a ranging market because you can see the line is here. A few candles are above it, a few candles are below. It's a ranging market. But a clear uptrend looks like this. The line is below all the candles. So this is an uptrend. A clear downtrend, the candles are below the line. So when you see this happening, in essence, this is what I was explaining. The market is actually, this is an uptrend, and the market is making a high, low, a higher high, a higher low, a higher high, a higher low, a higher high, a higher low. But now we are using the moving average to help us recognize this. Now, you can do this with the 50 EMA. Remember, this is 50 exponential moving average. A better way of understanding the direction of a trend is to use 2 moving averages. So I will add another moving average, insert indicators, trend, and the moving average. I will now add 100. 100 is double the 50. So now we have 2 moving averages on the chart, 2 of them. Now, when I'm using the 2 moving averages, this is how I analyze the market. When the 50 exponential moving average, the green one, is above the red one, which is 100. Now, 50 moving average means this line is taking an average of the past 50 candles. Each of this is a candle. I believe you are aware, you are familiar with candles by now. At least you know what candles are. Please confirm. Confirm you are comfortable with what candles are. It's not something new. I don't seem to get a response from you. Are you okay with candles? Just a nod would be fine. All right. So when the green one, which is the 50 EMA, is above the red, which is the 100 EMA, this is an uptrend. As long as green is above red, it's an uptrend. Uptrend, 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 Now, when the green one is below the red, is a downtrend. Now we start a downtrend here. When they cross, the two lines have crossed. Now the 50, which is shorter than the 100, is below. So in this case, this is a downtrend from here, downtrend. Uptrend starts again when green goes above red. So you can use moving averages to tell you the direction of the trend. Okay? Are you following? Are you following? All right, type an okay to confirm you are following, because I don't seem to get a signal from you. Just type okay. That way I'll know that you are following. Please type an okay to confirm you are following what I'm saying. Good. So let me simplify how you can determine the direction of a trend using moving averages. Remember, we are talking about trend analysis using Dow's theory. Dow's theory is the one I've already explained, using higher highs and higher lows, lower highs and lower lows. Now I'm using moving averages also to do the same thing. So you can define a trend in this manner also. You can say that you are in an uptrend if, okay, you can have an uptrend if 20 exponential moving average is above 50 exponential moving average, and the 50 exponential moving average is above 100 exponential moving average, and 100 exponential moving average is above 200 exponential moving average. You can say you have a downtrend if your 20 EMA is below 50 EMA, and the 50 EMA is below 100 EMA, and your 100 EMA is below 200 EMA. So this is how to use moving averages to determine the direction of the market. Okay? So let me show you what to do. In our case here, it's very easy. It's not difficult at all. You make your first line, make it 20. Second, you can add a second moving average, 50, make it yellow. Then you have this one, make it 100, and you have a last one, make it 200. Blue. Now look at those lines carefully. 20, 50, 100, 200. 20, 50, 100, 200. So if 20 is above 50, and 50 is above 100, and 100 is above 200, you have a clear uptrend. That's a clear uptrend. As long as they remain in that order, that's an uptrend. Uptrend. When the order changes, you don't have that uptrend. That uptrend is disturbed now. So let's look at the downtrend. When 20, here, this is a downtrend. When 20 is below 50, and the 50 is below 100, and 100 is below 200, which is the opposite of an uptrend, this is now a downtrend. Now, as a trader, this is very important. This is very important, and this is what I teach. People might teach different things. This is what I teach. In an uptrend, you only buy. In an uptrend, you only buy. In a downtrend, you only sell. That's why you need to know the trend direction. That's why I'm spending a lot of time teaching you about trends. So when you see this is a downtrend starting here, when you notice the moving averages have aligned themselves in the sense that 20 is below 50 and 50 is below 100, or 100 below is 200, you don't have to remember the, if you have set your chart, you just need to remember, I've used the traffic lights, green, amber, is it, or yellow, red? I think that's how traffic lights operate. Green, yellow, red, something like that. So if green is below yellow and the yellow is below red and red is below blue, this is a downtrend. All you need to do in a downtrend is look for places to sell. This is resistance, you sell here. This is resistance, you sell here. You sell here. Only, you don't buy. Now, in an uptrend, this is a nice uptrend here. The lines have arranged themselves in the correct order from here. Green above yellow, yellow above red, red is above blue. From here. From here, we have an uptrend. So all you need to do in an uptrend is look for places to buy. And you start buying in places like this. You buy in places like this. You buy in places like this. So when you're about completing the course, you will have known why I put those arrows there. Those are places where you can possibly buy from. Okay? Because for me, I know when we cover the topic of support and resistance, there will be a support here. I know there is going to be a level here. We buy from here. I know there is going to be a level somewhere here. So we can buy from here. But as I said, because it's an uptrend, we only buy. We don't sell. When we are in a downtrend, we look for levels where we can sell from. This is a downtrend. So I look for places where I can sell from. One place is here. Then I look for another place where I can sell from. If I start drawing these lines, this will be another topic. I will sell here, I will sell here, I will sell here. Okay. So that's generally the purpose of a trend direction and why you need to follow the trend. So remember, a market could be trending up on one. Generally, just I remove these two. If I remove these two, I remain with, I just like remaining with 2 lines in most cases. They are fine. 2 lines are fine. When there are 4, they look like they're a bit confusing. 2 are fine. Uptrend, uptrend, downtrend, uptrend, downtrend. Much better that way. So this is the 50 EMA and the 100 EMA. Now, that's about trend analysis. I would like to take a few questions from you on this trend analysis. Type your questions if you have one. Because we are coming to the end of our first session, we were talking about trend analysis. Now remember, if you don't understand trend direction, if you don't understand trend direction, like this is an uptrend, this is a downtrend, this is an uptrend, this is a downtrend, then you might find it very difficult to trade Forex. You need to be aware of where the market is moving. The market is moving down here. You move with it. The market is moving up. You move with it. That's what I'm saying. When the market is moving up, buy so that you go with it. When the market is moving down, you sell so that you move with it. Are the concepts for today clearly understood? Kindly just type a message. In that case, now that your audio is becoming a problem, type a message if you understand all the concepts for today. Okay, reply to my message there. Do you understand how to analyze trend direction using higher highs concept and using that's using Dow's theory and using moving averages? Please confirm so that I know we are together. Okay, so then let me suggest this. Try to find a mic, a working mic. You can get a headphone, plug it to your laptop, so that at least I can get to hear you talk in our next session tomorrow. Because there are things you would want to explain, you would want to stop me along the way as I'm explaining things. We'll need you to have your mic so that then you can always interrupt and ask questions or make make observations. Otherwise, that is it for today. Tomorrow, God willing, we will talk about candlestick patterns. Candlestick patterns. Or maybe I can even introduce support and resistance. One of them. Support and resistance. I want you to start observing the market. These candlesticks look like they are running randomly. When you are new, you look at the chart, it's very random, completely random, like up, down, you don't even seem to understand what's happening. But I will explain to you that there's no randomness here. If you look at it, the market's observing some patterns. Came here, stopped, came here, stopped, came here, stopped. And went above it, respected the same line, respected the same line. This is support and resistance. If you understand this, if you have already covered trend, you understand uptrends and downtrends and ranging market, you understand support and resistance. Places where the market stops and reverses direction, stops and reverses direction, stops and reverses direction. Then you understand candlestick patterns. 50% of your journey is complete, more or less. So tomorrow, God willing, I will talk about support and resistance. Support and resistance. These lines I'm drawing, and I'll show you how to draw them. Now, once you have drawn those lines, then we can talk about you taking signals. How do you look at a chart like this and decide, do I sell or do I buy? We leave it there, I think, for today. Thank you so much. I will see you in the next session tomorrow. We can make it 7:30. Are you okay with that? 7:30. 7:30 a.m. You okay with that? Okay. So I will send you this video through your Telegram right now. So don't go away. Immediately I end this video, I will send it to you through Telegram. Download it and watch it, and then you can make your notes. Thank you so much. See you tomorrow, God willing.